Welcome to a special episode of Cup of Joe. Today, Nick and Mike sit down with three of Ryerson's supply chain directors for a deep dive into everything from material availability to shifting global demand. If you're planning for the year ahead, or just trying to stay ahead of fluctuating market conditions, you won't want to miss this conversation. So, grab a cup of Joe, settle in, and get your questions ready. But first, a special message from Ryerson President and CEO Eddie Lehner.
Welcome everybody to this special edition of Cup of Joe, and also Engage 2025. Want to wish everybody out there a happy new year, and let's make it a great new year in 2025. And thanks for making this special edition, an episode of Cup of Joe, a part of your day and spending that part of your day with Ryerson. So 2024 in review was a tough year. It was a difficult year. Demand receded further from 2023, which also we started to see demand declines after the middle of 2022 for industrial metals and manufacturing, and prices continued to decline throughout the year. So with the PMI being in less than 50 and in contractionary territory for 26 out of the last 27 months, it has been a difficult manufacturing economy, especially domestically here in the U.S. For throughout 2024. Now let's see what 2025 brings, because there is a lot of latent demand in this economy, and we should be due for an upswing in manufacturing as we move through 2025 and even into 2026. Because I will tell you that this counter cycle or downturn in manufacturing, particularly in the U.S., it's been a long one by historical standards. When we think about 10 of the last 12 quarters have been recessed or recessionary or counter-cyclical, as per the service center industry metals in manufacturing. We are due for a pivot and an inflection and coming back on the upside, because I don't think the secular demand that's in the economy, that's in North America, that's in the world, has been met or has been satisfied. So I expect that 2025 is going to be a better year and lead us into an upturn, even if it's slow to start and incremental at the outset. But here's the message that I want to leave with the viewership as we go through the rest of the program for this edition of Cup of Joe. And it's very familiar to those of you that have heard my introductory comments over the years, or maybe caught me on a panel or speaking somewhere else over the last several years. But that is a very common theme and something that I am passionate about, and that is manufacturing and the middle class. If the last 50 years, and particularly the last 25 years, have shown us anything, and hopefully taught us something, it's empirically, there is no doubt that manufacturing and industrial metals and the middle class, they have to have primacy in our economy. Ryerson's been here for 183 proud years. And so when we look through that historical lens, but we also look to the future, we know one thing above all else to be true. We need to be a nation that builds things. We need to be a nation that innovates, but we need to be a nation that also makes things. So manufacturing in the middle class should be our national priority, particularly at this moment in history. And I want to use this analogy, and then I'm going to turn it over to Nick and the rest of the Ryerson team to take you through the rest of this edition of Cup of Joe. But I'll use a bowling analogy. When you look at all the information, you try to distill it into a coherent view of the world and of the economy and the things that will affect us, even if they're not in that moment, in that hour, but the things that will truly affect us in the days, weeks, months, years, decades ahead, it is this. And that is, when you bowl, you look to apply enough strength, enough spin, and enough placement to hit as many pins as you possibly can to get the highest score that you possibly can. So in bowling, and this is the metaphor and analogy, it's when we prioritize manufacturing in the middle class, we hit the most pins possible, we ring up the highest score possible, and we get the best outcomes over the short, medium, and long term, especially when you think about everything that we have to apply in technology, in know-how, and in the infrastructure and the history that we have everything we need to rebuild the manufacturing economy, take it to a new and great height, and also build back the middle class. And by doing that, we knock out the greatest number of pins possible. We ring up the highest score. And that's what manufacturing does. It builds the middle class. It creates the most broad-based and shared prosperity and wealth. And we need to continue this journey and this passion to make this the national priority in this economy. And with that, I want to turn it over to Nick Webb, who's going to take you through a great edition with some of our other Ryerson folks and such subject matter experts. So have a great Cup of Joe episode, and I look forward to seeing you in manufacturing and in the field as we get through 2025. And let's make it a great, healthy, and prosperous year. Thank you.
Thank you, Eddie. What a great lead into what's a special 90-minute episode of Cup of Joe. I'm Mike Carrozzo, your host through this journey this afternoon, but the real star of the show is the man to my left on the screen here, Nick Webb, our Director of Risk Management Commodities Hedging. Nick, good afternoon.
Good afternoon, sir. I wasn't expecting that bowling analogy today, but I'm hyped about it.
Yeah, I've seen that a few times as we've gotten prepared for this, and I started thinking about, it makes me think of when my daughters are 8 and 10, when we take them bowling, right? They put up those little bumpers in the gutter, yeah. Right? So like, I feel like in this journey that Eddie's describing, to take his analogy forward, right? We're kind of those bumpers that keep you out of the gutter and hopefully get you going and hit enough pins. How does that sound?
I love that extension of the analogy. I think that's exactly right. And that's what we're trying to do here. We're bringing in the best information to keep you somewhere centered in the lane to hopefully give you the best chance possible. But Mike, what's your highest score in bowling ever?
I don't know, 100 and something. I don't know. I'm not a bowler. So I don't know. I know I'm going to go 160 or 180. Is that good?
Not bad. That's not bad.
Yeah. How about you?
Well, I'm a weird one. I'm going to embarrass myself because I'm a very volatile bowler. I don't keep it down the middle of the lane. So I know for a fact that I've bowled as low as a 19 before, and I've also bowled a 219 and everywhere in the middle. So there's no consistency. Maybe it's the drinks. I'm not sure.
Well, they say you got to keep bowling to keep your score going up, I guess. Right.
That's right. That's right.
But in all seriousness, I think it was a really great lead in. Eddie, really a strong message there. We really are kind of at a pivot point when he puts out those numbers about, the PMI. What did he say? 19 of the last 20. Was that?
Yeah, right? Basically 2 years straight.
Yeah, or 26 of the last 27. I'm sorry, and then 10 to 12 quarters for the the demand lagging. So I think like it shows. I think manufacturing being resilient through all that is a story in itself too, right? That still see a lot of strength, and there's some headwind coming into this year. So I think it's a nice lead in.
Yeah, it's right. And Eddie, I swear he didn't see my slides. I think only the 3 or 4 of you have seen the slides. The title of today's discussion is Economic Reversion, and it really does kind of harken back to what some of the things that Eddie had said. I swear we didn't share notes or anything, but with that, shall we go ahead and hop into it?
Well, let's. You had mentioned the three gentlemen we have on the screen here.
Oh yeah,
let's. We're gonna. It's an hour and a half, so Nick's got a little agenda he's gonna bring us through, and we're gonna have 3 of our Ryerson supply chain directors chiming in throughout. I believe all of them have made prior appearances here on Cup of Joe. First we have Keith Kessler. Keith, welcome to the show.
Thank you, Mike.
He's our supply chain director for stainless, and Jeff Notice from aluminum.
Good afternoon, Mike.
And last but not least, Mark Gross, our supply chain director for carbon steel.
Hey, good afternoon. Glad to be a part of this cult phenomenon known as the Cup of Joe.
The
Happy
only
to
one who
have
took
you.
a marketing class, apparently, with the Ryerson background.
That's right.
Thank
Yeah,
you. Welcome to the show.
And as Mike mentioned, I mean, this is going to be 90 minutes. So this is going to be Nick Webb being a blabberbox, but to the extent we can, we're going to have interjections from hopefully not just, our four other panelists, but also from Q&A from all of you. So, interrupt it. Mike will do his best to interrupt me and shut me up, but we got a lot of slides. I actually have 61 slides that we're going to run through here today. But we got a lot of really good content. We put a lot of work into this, put a lot of thought into this. We know a little bit more about what this new administration is going to bring to the table. And we're going to share those thoughts and ideas with all of you.
Well, you bring up a good point for those who it may be their first time on Cup of Joe, right? We do have a live and interactive show going on here. So send your questions down at the Q&A button at the bottom, and we're going to try our best to get to them.
Excellent. So before we hop into the slides, as we always do, we got to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrozzo, Keith Kessler, Jeff Notice, and Mark Gross. These are not the opinions of Ryerson as a whole. Do your own research. Like I said, we got a lot of great content in here that we're going to cover here over the next 90 minutes or so. So buckle in, grab yourself a cup of coffee. First things first, I think this is probably front of mind with the new administration in place. We're going to cover the latest on the quote unquote trade war. And there's a reason why I put that in quotes. So let's go ahead and start off there. So what do we know thus far? Well, we come in on February 1st, and for all intents and purposes, everybody in North America is expecting tariffs to go into effect over the weekend. And what did we learn? Well, basically at the 11th hour, the threat was that Canada was going to get 25% tariffs placed on them, with one exception being on energy products. Mexico was going to get 25% tariffs placed on them with no exceptions. And then China would get a blanket 10% tariff on all goods being imported into the United States. And it is worth noting that's in addition to Section 232, 301, anti-dumping, countervailing duties. This is in addition to all of those things. What do we know now? Well, a lot has happened. First thing I want to touch on, on the previous slide, I put the trade war in quotes. And the reason why I put it in quotes is because there's at least a potential that this isn't, in fact, a trade war with Canada and Mexico. I say that a little tongue in cheek, but the reason why I bring that up is President Trump has been pretty specific in saying that the reason why he put in place this emergency act of 25% tariffs on Canada, 25% tariffs on Mexico is not because of the trade of goods. Instead, he's citing basically border security, immigration, fentanyl, drug trade, very specifically. And I think there's a reason why that occurred, and maybe there are others who have deeper insight into this, but it seems as though he kind of sidestepped the whole trade notion so that it wouldn't have to get further approval from Congress. It allowed him to kind of take these steps without having to get those additional checks done. So I think the first question is there an issue? Is there a legitimate threat that Trump is referencing when he cites immigration, when he cites the drug trade? Over on the left-hand side, I would say this is maybe more of an opinion than anything, and I don't want to get too deep into politics here, but ultimately this is a very long-term chart of immigration trends into the United States. The blue line is the nominal number of immigrants, and then the orange line is showing the percentage of immigrants in the United States as a percentage of the overall population. And interestingly enough, this is actually kind of eye-opening to me as I was doing my research for today's discussion, in that on a percentage of the overall population, we're actually kind of just back to levels that were about 100 years ago, call it around the Ellis Island type time frame. So they are certainly higher than where they've been over the last several decades on both a nominal basis and a percentage basis. But whether that's a good thing, bad thing, I'm going to leave that to the audience to think about those things. But that's one of the items that's ultimately being discussed. And here we are 2 weeks into the administration, and there are already some pretty aggressive things taking place with regards to the border security. But while we're on that topic, the day before the tariffs went into place, both the Canadian administration and the Mexican administration came to Trump and basically negotiated. And what they've arrived at thus far is putting about 10,000 border agents to secure the movement of people and ideally to secure the movement of drug trade across these borders. And I believe the commitment was right around $1 billion, maybe just north of $1 billion, being invested in the protection of those borders. So both have come to, and again, the reason why I bring this up is that is what Trump, at least verbally, publicly, is citing for the tariffs. So what can that mean as we sit here today? There is a chance that if we actually do see progress being made with regards to drug trade and immigration, if it actually takes effect, this 30-day delay of the 25% tariffs and 10% tariffs on energy may actually become permanent if these themes continue to persist. So that's kind of my base case for now, is that those initial tariffs on Canada, Mexico likely will continue to get kicked down the road as long as the Mexican administration, Canadian administration kind of cooperate on these two themes. Because like I said, I think any further trade related tariffs, at least based on what I've been reading, would require further approvals from Congress and for further checks and balances. I didn't talk about it much, but over on the right-hand side, I personally don't think this one's all that heavily debatable. We certainly seem to have an overdose and fentanyl, I would even call it a crisis, in the last several years that I think is certainly worth, not just in the United States, but everyone globally addressing, because you certainly don't want those unwarranted deaths.
And I'm sorry, I'm going to jump in, but the understanding, right? So it's pushed out 30 days, right? As long as they continue to negotiate on that, or things continue, it could continue to get pushed down the road. And I think what at least I saw from when the talks came over the weekend, right, and it's getting closer, the market really opened up with a hit, right? But then when these were announced, when they went to the table, they being the Mexican and Canadian, the prime minister and president respectively, corrected itself a little bit, right? So I mean, is there a fear of like this, every month are we going to be seeing a knee-jerk reaction on the markets, right? I mean, that could create for some whiplash for sure.
Yeah, I mean, you're kind of jumping into my 5 predictions for 2025, but yeah, I think that we've already seen several instances of this knee-jerk reaction and knee-jerk approach to public policy. We saw it with Colombia 2 weeks ago already, with regards to immigrants being sent down there, whether or not Colombia was going to cooperate in taking them. We saw that play out on Twitter in about an hour. These things are coming fast and furious, and they are moving markets. To your point, whether it's the stock market or whether it's metals markets, which we'll obviously have to talk about later here in this discussion. It's moving, and it's moving fast in both directions.
Yeah, it's almost like, okay, breather here for 30 days, right? But like, how are you long-term forecasting, right? And we're going to get into all of it for sure, but I think that's what's on the mind of everybody.
It certainly is making it very difficult, but what we know right now is 0% tariffs, at least 0% additional tariffs, aside from the things that have already been tariffed with regards to 232, 301, things like that. But even if the 25%, even if tariffs go into place, I think it is worth noting that there's already some pretty heavy speculation that within that energy, that 10% exception for Canadian energy, already there's a belief that things like nickel, things like aluminum are going to get special carve-outs because they would be deemed critical minerals for the United States, and they would actually be subject to the 10%, not the 25%. So a little bit of a consolation for volatility in the metals markets. Want to make sure I touched on that. If in the event, 30 days from now, we do see the tariffs actually go into effect, it may not be 25, it may just be 10.
I didn't mean to park it here, sorry, but like I know, and this wasn't as well publicized, at least in my opinion, at least I didn't see that 25 was not going to be applied to energy, and I didn't know that, so that's good, right? Because the Midwest, I didn't know too, gets a lot of its oil reserves or gasoline's coming in through Canada, right? Yeah. So I think, and that really impacts the Midwest. So that's one thing I didn't grab the headline, but I'm learning of that right now.
I think we import like 3.5 million gallons per day, or million barrels per day. Which is a real substantial number if you block that off. And as I understand it, I'm not fully an energy expert, but as I understand it, the grades of energy, the grades of crude oil specifically that come down from Canada are actually necessary to the makeup of our overall refining network. So if in the event they actually did tariff or put quotas, God forbid, on Canadian energy, you all of a sudden probably spike up energy markets pretty quickly. And one of Trump's big sticking points for his campaign in the last 6 months or so has been drill baby drill, and part of that is getting energy prices under control. And in my opinion, blocking Canadian energy markets would kind of do the opposite of that.
All right, I got a lot of slides to get through.
Yeah, no, you're good. You're good. This one, again, I found very, very interesting. Eddie talked about this notion that over the last, let's say 20, 30, he referenced 50 as well, years, that things have really changed within the manufacturing environment. And what we're looking at here is not necessarily just manufacturing, it's looking at trade flows. But apologies, everyone.
You're getting hit up live.
just getting hit up live.
Use the Q&A button, please.
Yeah, that's right. As we're looking at trade, what this is showing is anything representative of blue, that is anybody who has a larger trade relationship with the United States. And this is as of 2000. Just a quick overlay, fast forward 20 years, compare that to 2020, it's a mirror image. Now you see the number of trade partners who have heavier trade relationships with China than with the United States. And it's almost hard to find blue in this picture, aside from Canada, Mexico, a couple nations within South America, France, Italy, Great Britain, Iceland, and then interestingly enough, Afghanistan of all places.
I was going to ask, who's that one country in?
Yeah, no, I pulled up a map when I saw the blueberry and the tomato soup. But yeah, no, the point of this is ultimately to come back to Eddie's point, which is a lot has changed with regards to manufacturing, with regards to trade flows, and with regards to trade deficits and trade surpluses. And it's shifted, at least with regards to trade and manufacturing, away from the United States. While we're sitting here on this map, I'm not going to spend a whole lot of time on this, but the last 2 weeks, you talk about volatility in markets. In the last 2 weeks, as we look around this map, we've got Trump, going after Panama to try and get rights to the Panama Canal and take away, its relationship with China. And it looks like that's somewhat underway as we sit here today. Looking around the world, we've got Iran. It looks like this administration is going to be placing some pretty severe sanctions on Iran and potentially its ability to make money with crude oil exports. So, that could be something where we see some volatility. Let's see where else obviously you've got China getting hit with the 10% tariffs, and those are staying in place for the time being. And we'll touch on China here in a second. Ukraine, it looks like there are some early rumblings of potentially a ceasefire that's being negotiated, talking about maybe splitting some of the middle ground land. That's pretty fresh stuff as of today. And then looking at Europe, we haven't gotten anything specific with regards to tariffs just yet, but there is a looming risk that Europe could actually get its own tariffs placed on it here in the not too distant future. We'll have to see how that one plays out. And then up there in the top middle of the chart, we've heard the headlines about Greenland. Discussion with Greenland to basically come up with ways to have some sort of security to the northern part of the globe where, potentially ballistic missiles could come over towards North America. So the point of this is basically to say there's a lot going on. There are a lot of moving pieces. We don't know how all of these are going to play out just yet, but we want to make sure we keep an eye on all of them because they are going to have impacts on supply-demand balances for sure.
Yeah.
Now, interestingly, on the Chinese side, I think this is the only main slide I have on the Chinese tariffs, but it's really just to show that when you compare the dollar amount that the U.S. tariffed against China, which is shown in the light blue, against what they retaliated with over on the left-hand side, they're vastly different. Most analysts are kind of viewing this as saying it looks like China wants to take a slightly softer approach to tariffs and not, let this blow up into a full-on trade war. But within that $14 billion, which is a much smaller figure than what we've tariffed them with, it is worth noting there are a couple specific and targeted things that we want to cite, which is tariffs on coal, LNG, liquefied natural gas, crude oil, agricultural products, and then potential export bans on things like rare earth metals. And within that, you've got molybdenum, which could have impacts on stainless steel, particularly 316 stainless. There could be risk that we see some impacts to magnesium. And Jeff noticed, if you remember back a few years ago, we saw basically a run on magnesium or shortage of magnesium. We saw prices shortly spike up for a period of time. So it's not to say that China didn't do anything to retaliate. There is a potential that these things have some knock-on impacts to the metals industry. But nominally, from a dollar standpoint, they are much, much smaller, which would be good news if this is kind of where it stops, in my opinion. I just found this like kind of interesting. It's more just that's fascinating. This is showing, as we look around the United States, all the different states who have and their biggest trade relationship. And I think for the most part, it makes logical sense. Your northern states mostly have their relationships with Canada, western states, maybe a little bit more with China, southern with Mexico. But I found this kind of interesting as you think about, how could these potential tariffs impact me and my specific manufacturing state. Keep this table in mind, because it is going to be dependent on where the chips ultimately fall with regards to tariffs. So, if the Chinese tariffs stay in place, states like California, Nevada, Florida, Georgia, South Carolina are likely going to get hit a little more incrementally harder than other places.
Washington, D.C. and Australia. That's the biggest disconnect. Everyone else kind of makes sense. Although I
didn't have a ton of time to peel back the onion on finding out why exactly that is or what products it would be. But yeah, some of these are a little fascinating.
Cool. Yeah. And
last but not least, as we try and think about what the market impact could be, I expect that any region that gets hit hard with tariffs, they're going to respond, or the market is going to respond by seeing a further weakening of their currency. So I've just got a chart here showing the Canadian dollar in white, the Mexican dollar in blue, which has already seen some pretty substantial deterioration over the last 12 months, and then the Chinese renminbi in orange. The idea there is just one way you can combat tariffs is to actually weaken your currency by a similar amount, and that actually provides kind of a trade buffer. It almost negates the tariff even going into effect. So that could be something that we see as we get further trade headlines around these tariffs. But already we've seen a little bit of weakness in the last couple of months in both the Canadian market and in the Mexican peso.
If you don't mind, before we move on from I'd love to get the thoughts from the panel here about, when you do talk about tariffs and trade policies and things of that nature, there's little slivers that impact each of the market, right? Like, so like, and Jeff, I start with you as the example, right? Is like,
Sure.
If oil, energy prices go up, then like the Midwest premiums hit, and that's a component to aluminum. So I guess I'd like for each of you, like, what's the specific biggest impact that could potentially hit your respective metal, if that makes sense?
Well, I mean, for aluminum, you touched on it. If this tariff goes in on Canada, you saw the rumblings at the beginning of the week when we thought we were going to see the tariff go in on Tuesday. Lots of conference calls, a lot of activity going on with where we saw ingot values, but it's the Midwest premium that would be impacted the most. Yeah. And I don't want to steal any of Nick's thunder on it, because I think he has some slides coming up, but a 25% tariff and the percentage of prime aluminum that's coming out of Canada into the U.S. is a big number. It's a significant number.
Yep. Mark, how about you with carbon?
So, two things come to mind, and mainly on the raw material side. I think there's a little bit of exposure to scrap. I don't think there's going to be a shortage, per se, but I think it could have an impact, escalating scrap prices, and also zinc. I think some of the re-rollers, particularly in the northern geography, I think rely on Canada for some of their zinc, and that could impact galvanized coating weights. You could see an increase there. So,
okay, yeah. And Keith, is it mainly molybdenum for
Well,
stainless?
moly would be the ingredient, yeah, Mike, that would be most impacted. So type 316 stainless has a notable moly count in it. And then it's probably more related to what other countries end up being impacted, if any. So we'll have to see how that plays out.
Makes sense. Okay.
And we'll talk more about that as we get into the specific metals as well. Going back to Eddie's commentary around the weakness that we've seen within the manufacturing space, I think this chart shows it pretty poignantly, and it also highlights the original title of the presentation, which is economic reversion. What we're showing here in this chart is going to be the ISM manufacturing PMIs going back to 2010. That's in the white line. The blue line is going to be the ISM services economy. So that's going to be things, basically the other part of the other 80% of the economy. That's going to be things like technological services, travel, retail, those types of items. And what you can see is, they generally tend to move somewhat in lockstep with one another, but because I would say our industries are a little more cyclical, we tend to see the dips be a little more severe within the manufacturing space. And this cycle's been no different. We've seen, not just in terms of magnitude, but also in terms of duration, the weakness that we've seen within manufacturing activity for the last 24 months is pretty well evident down there in the bottom right corner. So we've been in weakness territory for this entire 2-year time frame, and yet services activity has largely been in growth mode still. And what I think, partially a prediction, you'll see here at the end of the discussion, I do think we're going to see some reversion of the manufacturing market actually, picking back up relative to the services side of the economy. Where you can see it maybe even more distinctly is when you look at equity markets. Up there in the top right corner, this is showing, so we're looking at baskets of ETFs, which are exchange traded funds. That's just, funds that are comprised of different sectors within the economy. And what you can see is when you go up to the far top right corner, you've got things like communication services, technology, maybe your higher end fancy industries have performed extremely well over the last 2 years. In many markets, you have stocks that are up 100%, 200%, maybe more in some instances. Meanwhile, you've got other parts of the economy, what I would call maybe your old school economy or your real economy or physical world economy, that have performed much worse. And I would say that's kind of echoing what we saw on the previous slide, showing manufacturing activity just kind of being a laggard to the rest of some of these technological markets. And in my opinion, I think a healthy economy kind of has both moving somewhat in lockstep with one another. We really have not seen that over the last 2 years. We've seen massive divergences in performances. So down in the bottom right corner, you've got energy and utilities and materials and real estate. In those cases, you have a lot of equities, and this is not stock trading advice, but you have a lot of steel names that are trading below book value right now. On the technology side, you've got Palantir that's trading at 25 times revenues, which is, for those who don't know, that's a very lofty valuation, and maybe they grow into it. But the divergences are very, very wide. And again, I'll cover this a little more at the end of the presentation. But I think we're going to see some recovery on the old school economy, and maybe a little bit of a leveling out or taking a breather on the technological side of things.
It's been a theme for you for a few years now. Revenge of the old economy. Is that am I foreshadowing?
No. I mean, so I think that was actually one that I highlighted. It was 2 or 3 years ago, but it was certainly one where things just got a little out of hand. There was a frenzy in technological stocks and Bitcoin, and we may be back in something that feels a little bit like that right now.
Yeah.
Now, looking at PMIs, so purchasing managers indexes, for those who are new to the podcast, these are surveys that go around to purchasing managers all over the world. I've got them categorized by their region over on the left-hand side, and you can see left to right, these are the last 12 months. Looking at the key areas that we deal in and that we watch, so global, North America, China, and the Eurozone, been pretty lackluster for the better part of 12 months. It's going to be much like what we saw in the ISM data, which is going to be a similar survey on manufacturing activity. But you'll notice over on the very far right-hand side, small glimpses of optimism, positivity, where you see some of these regions like the global figure, the US, Canada, and even China that are in positive territory. They aren't going gangbusters. They aren't doing anything like what we saw back in 2021, 2022. But it does feel as though we are seeing potentially some early signs of optimism within manufacturing. Now, where we're seeing that strength, it is a bit of a mixed bag. There are certainly the haves and the have-nots. Things like HVAC shipments, as it relates to data center growth, are doing extremely well right now. I've listened into a couple of these earnings calls, and I think Microsoft is committed to spending $80 billion on data centers. I believe Google yesterday came out and said they're going to spend $75 billion on data centers. These are huge, huge numbers. But when I talk about, the manufacturing economy kind of having to go with technology, this is sort of where those two things can kind of converge, because you're not getting data centers without concrete demand. You're not getting data centers without the racking systems. It's going to be, probably galvanized steel or coated steel of some sort. So these things should somewhat go in lockstep with one another. So as the spending numbers come in, there should be some sort of tailwind to the manufacturing economy.
With that being said, data centers, right? I mean, that's obviously a boom, right? And Facebook, I think you said, right, you announced a big investment there, but isn't that one of the, so DeepSeek, the AI come out, right? They claim to have brought that to market at a much lower cost and a much less dependency on building these big data centers, right? Is that another, I would imagine that's something else that really kind of puts a wrinkle in the market too. But I mean, how accurate that is, I don't know. But
yeah, at the very least, it is a wrinkle. At the very least, it is a risk. There is some speculation out there that maybe they didn't, in fact, build their models with as little of money and as little of equipment as they say. There's a chance there, and this kind of comes back to the trade war with China. There is a chance that they may have illegally gotten H100 chips from NVIDIA, and that's how they were able to do the things that they did. A lot of speculation around that, but yeah, I mean, we're given the fact that you've got U.S. companies spending such large dollars, there is a lot of there's a heavy microscope being placed on this entire landscape, because if in fact you can do things with less money and less equipment, then that whole capital expenditure narrative fizzles out pretty quickly. But it's interesting, already you're starting to see nations around the world, including the United States, debating whether or not they want to ban DeepSeek, because I haven't spent a whole lot of time with it, but as I understand it, just signing up with DeepSeek, you give them access to your entire Gmail by doing so. So pretty interesting, like border security, national security type risk, privacy issues that could be afoot as well. But no, that is one that I think a lot of analysts are watching closely.
It just reminds me when we had Chelsea Hunt on mid-year last year, right? She's our vertical market manager and energy data centers, things like that. What did she say the equivalent to doing a search on, or a query on ChatGPT was like flushing like a case of water down?
I think it was like a gallon of water. Yeah.
Yeah.
Uh-huh.
Yeah.
Yeah. The energy usage and the water consumption is pretty through the roof.
Yeah.
Yeah. Now, the next few charts I'm going to show you are going to look fairly similar, but it's really to drive home the point that I believe we're beginning to see, at the very least, stabilization in manufacturing activity, but maybe even some early signs of an inflection point higher. And I actually tend to believe this is an inflection point higher. What we're looking at here, this is the Institute of Supply Management. One of the line items they look at is new orders. Are new orders picking up, or are they getting worse? And you can see that we now have a trend of 2 months where new orders have gone into positive territory pretty strongly too. I will recognize that part of that could be the fact that there could be some pre-buying from manufacturers in the US trying to get in front of any tariff risk. But it does look like it's a pretty strong figure. And we've got some other data that supports this as well. When we look at core capital goods, very similar looking chart. You can see stabilization with small tinges of optimism moving into positive territory there on core capital goods. So that's going to be basically durable goods less aircraft shipments, because aircrafts tend to be very, very volatile. Similarly, industrial production, which that's not a survey. Durable goods is not a survey. These are hard data points that are not just stabilizing, but actually moving slightly into positive territory. So again, all these kind of look similar, but they should, because it looks like there's a fairly concerted message within the data saying it looks and feels like the last 2 years that were pretty not fun for the manufacturing space. Maybe starting to see a new dawn. And then last but certainly not least, this one is a survey, but this is small business optimism. So this is a survey done, and you can see that in the last several months, it has just soared. And perhaps not coincidentally, it looks a whole lot like exactly where we would have been about 8 years ago. So I'm not trying to say that manufacturing loves Donald Trump, but I'm certainly not saying that they don't love Donald Trump, because it looks like there's a little bit of a theme with him being in office. And I would say going around the country, meeting with some executives within the manufacturing space, they are at the very least viewing the administration as being one that is very anti-regulation and very business friendly. So lower taxes, lower restrictions on doing business. And I think most executives are viewing that as a pretty positive thing for the time being. We'll see if these policies, meet rubber with road, but But thus far, the feeling and optimism is certainly out there.
What's the categorization they use for small business?
It's a great question. You had to put me on the spot like that, huh?
No, sorry. to be continued. Sorry.
To be continued. I'll
Okay.
get back to you on that one.
Yeah.
And then I'll finish it off on two final slides on the macroeconomy, but you should be noticing a pretty consistent theme, which is it seems as though the worst is behind us in terms of this 2-year cycle of weakness within the space. Looking overall at the broader economy, GDP figures, which is, a high level popular gauge of the economy, 2.3%, not bad. It's really not a bad number. Consumption continues to grow at a 2.8% clip. I would say that overall the economy still looks pretty healthy. I think there's room for the manufacturing economy, the physical economy to catch up a little bit to some of these technological spaces, but overall the economy looks pretty decent. Because of that, we are seeing recession odds actually plummet over the last several months. So this is looking out 1 year. This is the probability of recession amongst economists at all the big banks around the country. So 23% odds of a recession, much lower than where we've been over the last 2 years. So there really is it feels like some tailwinds, calm animal spirits that are providing some optimism we haven't seen in a while.
So that's a lot of data points from the macro side, right? What's paint that picture coming out of that? What should we be encouraged? I mean, it certainly does sound encouraging, right? We talked so much last year about inflation and recessionary conditions and things like that. It seems a little the opposite now, right? Does it feel very confident going forward, or what are we thinking?
Well, these things can change at a moment's notice, and if trade wars erupt, these things can cause broader issues. But yeah, I think what does that mean? I think shipments, business activity. I think we're going to see growth figures finally versus what we've seen the last 2 years, where you saw, I'd say, mid-single digit type declines in terms of shipments, MSCI data, things like that on a year-over-year basis. I think those types of things can inflect. Now, transitioning that into the next section of these slides, which is there is some bad news with things running hot, which is it can cause inflation to perk back up. And as we know, the Fed's been fighting this fight for the last couple of years, trying to get inflation to come back down without actually, crashing the economy. Well, as we sit here right now, and I would say, this data point, which is the Bloomberg Commodities Index. So this is looking at a basket of commodities across crude oil, natural gas, base metals, precious metals, and agricultural products. You can see pretty consistently, broader commodities have seen a similar theme that the industrial metal space is, which is for the better part of 2 years, we've seen every single month we come in, prices are going lower for the most part. It's not in every case, but for the most part, commodity prices have been on the decline for the last 2 years. I've drawn in these moving average lines, the yellow line, the green line, and the magenta line. Those are moving averages, which are a gauge of momentum. And what you can see is similar to the manufacturing story. I would say worst case, it looks like we're stabilizing, but it does even look like we're beginning to see a little bit of momentum moving to the upside. So good news for manufacturing activity, bad news for the Fed, who's trying to bring inflation down. And I'll be empathetic and saying, potentially bad news for consumers of metals, because it could mean the prices are back on an upswing. And I would say that we are seeing a little bit of that in some of the industrial metals. And we'll talk about that in deeper detail here in a few slides.
What did the colors represent? Yellow?
Yes. So the yellow is going to be the 200-day moving average. So it's just looking back at an average of the last 200 data points of the index. The green is going to be the 100-day moving average, and then the magenta is the 50-day. So they're just looking at different time horizons of momentum, but they're all basically saying the same thing, which is momentum is currently to the upside.
Reversion. Yep.
And similarly, you can see it within the inflation data. So these are the actual inflation data points that the Fed would be watching to say whether or not they're doing a good job or not bringing inflation down. So this is core CPI, which is the consumer price index, PPI in blue, and PCE in orange. So core just meaning less food and energy. So food and energy is stripped out of this. It's looking at everything else. And what you'll notice is a similar story where it looks as though, the low-hanging fruit has been taken out already. And now we're getting into this phase of we haven't yet hit the target of 2%. And yet some of these inflation metrics are already starting to turn higher. So I can tell you the Fed is beginning to become a little concerned. And when we look at the market's expectations of the 5-year inflation rate, and perhaps not coincidentally, the Fed started cutting interest rates back in September when 5-year inflation expectations were just south of 2%. Well, since then, inflation expectations, which is just where do you think the inflation rate is going to be 5 years from now, it's done nothing but soar higher, basically to 1-year highs. So I had a chance to hear one of the Chicago Fed presidents speak a few years ago, and he said, in his opinion, this was one of the most important metrics to whether or not they won the inflation fight. Because once people start to expect inflation, it becomes very entrenched in the way they live their life. And I can tell you, if they're watching this chart or if they're tuning into Cup of Joe, they aren't happy about these data points. And that's corroborated when we look at their trajectory of what they're going to do with interest rates. So as you look in this second column here, the number of hikes or cuts, what this is ultimately saying is don't really expect between now and June to see any more interest rate cuts from the Fed until or unless they think something has changed dramatically. And what could change? Either inflation could move down substantially in the next couple of months, or the employment picture gets rapidly worse. If neither of those two things happen, and it's not yet looking like that's the case, I wouldn't expect any more spot interest rates to decline until at least summertime, despite the fact that Trump seems to be out there pounding the table for more cuts from the Fed. I don't know if any of you have ever checked out the usdebtclock.org, but I hopped on there a couple of days ago, and it's actually got a ton of really fascinating, some scary information on there. This is ultimately just to say that from an inflation standpoint, a monetary standpoint, we're still building a lot of debt and we're building a lot of interest. A couple of things I would highlight is just this section down here, middle bottom, the debt to GDP ratio. You compare where we are right now at 122%. We're carrying a lot of debt. No individual human would ever want to have that kind of debt to net worth ratio. It just you'd be terrified of bankrupting yourself. We have the ability to print money, so we maybe have less of a risk there. But you can see compared to 2000, 1980, 1960, we're at extremely elevated levels. And I don't think this current administration is really one that wants to shy away from spending. I think they certainly are pedal to the metal when it comes to that sort of thing, my personal opinion. But when you look down at the very bottom of this table, I think this one's pretty fascinating. You look at just the interest on debt. We are now spending over $1 trillion a year covering interest expense. As we think about where current interest rates are at 4.5%, as I understand it, we've got several $1 trillion of debt. So of that $36 trillion, several trillion of that is coming due in 2025. And it's going to have to be refinanced. And unfortunately, it's not going to be refinanced at the rate in which it was originally issued, which was probably closer to 1% or 0% when we had zero interest rates for 10 or 15 years. It's going to be refinanced at something more like 4.25%, 4.5%. So that's just going to speed up the trajectory of this interest expense payments, which, I mean, they're getting up into pretty rare air where they're only third in line to Medicare, Medicaid, and Social Security. So big numbers that's just going out to service our debt. If this is a company or this is an individual, not a great picture. So hopefully something's going to be done to address a little bit. I also thought this was kind of funny. Again, not trying to talk politics or anything, but they've now inserted the Doge clock, which is basically their counter of how much they claim they're saving for U.S. taxpayers.
There's a question here from the audience. Pretty interesting. Quite frankly, who's the interest paid to? Do we know?
Well, it's paid to anybody who's holding government debt, and a large quantity of that is going to be individuals here in the United States that lend money to the U.S. government for a fixed interest payment. A lot of that's foreign nations. China has a lot of our debt. So yeah, it's kind of I don't want to call it a dirty little secret exactly, but yeah, it is an interesting thing where we are beholden to, or the government is beholden not just to its citizens, but also to a lot of foreign nations who are holding our debt as well. It's a fair question.
Yeah.
And as I mentioned, I mean, the expectation is that this administration, I would say Trump in 2016, Biden in 2020, Trump in 2024, 25, really aren't all that different in terms of their interest in spending. Maybe it's gotten a little bit bigger, but the expectation is we're going to continue to deficit spend, all the way out into the end of this decade. So what's interesting about that, in my opinion, is this is kind of a fancy chart. I thought it was kind of cool, but ultimately what this is doing is trying to scatter plot or show a correlation between the unemployment rate and what kind of deficit the US government has. The idea behind this is basically saying, in general, you wouldn't expect the government to spend more money unless economic conditions are bad. And so economic conditions being bad is represented by a high unemployment rate. And I think that makes sense. If things are ugly in the economy, you would hope that the government would then decide to step up and spend some extra money and support the economy and hopefully get you out of that trouble. The reverse would also be true. If things are going really, really well, and the unemployment rate is really low, you would expect that you don't need as much government assistance supporting the economy. And you have that general relationship over the the 1960s through 2017. That relationship made sense and it worked, and that's what it was. We have kind of deviated from that, and I would say we began deviating from it somewhere right around the early parts of the Trump administration, and we've only gotten kind of worse. Where even though the unemployment rate is at extremely low levels, and we'll talk employment here in just a few slides, we are still spending. We're spending as if we're in a crisis situation as we sit here right now, and we have been for a number of years. So I don't think that's a healthy trend. I don't think that's a trend that helps to bring inflation down, because it's just pumping more and more currency into the economy and kind of creating some froth. But I thought this was a very interesting breakdown of the historical relationship.
Yeah, and I think we're moving into employment next, but I'd pause here, and you painted a really good macroeconomic picture. And I asked you in the last section, what's the feeling that people should have, and then you layer on this type of information. And I'd kick this over to the panel, I guess. You talk to customers, metal buyers all the time. What's the sense you're getting, here early on in the year? Is it a greater sense of optimism? Is it like what do you get? Is it much different than it has been over the last year? Mark, maybe.
Yeah, I for sure agree with that. Customers that I've spoken to, we're just a month into the year. There's a lot of optimism. We're seeing that, and kind of reported in our shipments as well. So we're customers are very optimistic. We're optimistic. So yeah, it's definitely on an uptick for sure.
Yeah, optimistic. I think more customers are leaning toward later in the year and expect business to pick up as we get into the second half.
Yeah, I think across non-ferrous, I think that's a similar story. On the aluminum side, I mean, what I see out there currently in some of our customers is there's a fair amount of optimism. Some of the forecasting numbers that we're seeing that are out there, I think Eddie alluded to in his comments, but 2024 was a little bit tougher on the aluminum side. So, I think optimism or an uptick, we're anticipating that going into 2025. And there's certain market segments that seem to be maybe showing a little bit more optimism. Semicon, I think, aerospace eventually, although that seems to be kicking down the can down the street. But there are some particular market segments that we'll touch on that I think we're a little bit more optimistic about than some of the others.
Yeah, I mean, just general fabrication, a core piece of business for Ryerson. Everyone that we talk to seems to be very optimistic.
Good to hear.
Yeah, and one quick aside that I'll say, these last two slides where I talk about government spending, government debt, in the short term, they probably aren't going to have immediate impacts on metals prices or the manufacturing economy in a big way. These are more kind of long-term trends of, I just hope, me personally, I hope we get some of these things back in order, back into a more normalized condition, because I think it's just healthy from a balance sheet standpoint to do so. More so just as an FYI, I find these things interesting than I think this is going to have an immediate and impactful situation to metals prices or metals demand.
Absolutely. Yep.
So yeah, flipping over to the employment side of things, I feel like we always do a cup of joes right before we get the unemployment numbers. They're going to be coming out. The new unemployment numbers are going to be coming out tomorrow. But as I mentioned, as we look back in prior cycles and where prior unemployment rates have been, we're still at extremely low levels. We've seen a little bit of an uptick in the last several months, and I do think this is a risk. But 4.1% is certainly not recessionary territory. If we continue this momentum higher, yeah, we may have something we want to be concerned about, and maybe the Fed then actually does step in and cut interest rates. But the expectation for tomorrow's unemployment rate is just a flat 4.1% week or month over month. So I wouldn't say that's going to cause any alarm bells to go off. But again, something I think we do want to keep an eye on, because it's an extremely important piece of the economy and does ultimately have a very heavy linkage to whether or not you're in recessionary territory or not. And right now it looks like very much so not.
We are working on trying to get the department to report on Wednesdays rather than Friday to
That's
not
right.
coincide with our. We got a message out there. See,
bring it up with Doge or something. Yeah, bring it up with Doge. I found this chart to be more just interesting than anything. The labor force participation rate. So this is of any U.S. citizens who are above 16 years old, what percentage of them are working? And you can see that from 1960 to 1995, let's say, you saw a very consistent theme of more people participating in the workforce. And I don't think it takes any real historian to say that was a theme of both partners within a relationship going to work. Not just the man being in the office and the wife being at home. Since then, that theme is really kind of unraveled, but the reason why it's unraveled is kind of fascinating. It's mainly because you have an aging population, and that population is quite large in the baby boomer population. So as more and more people get to retirement age or early retirement age, we are seeing these figures on the decline. We saw a fairly sharp decline during the COVID timeframe, which I think makes some sense. We had been creeping back up for the last couple of years, but it's kind of stalled out. And I thought that was kind of interesting, because this force of an aging population is a real one. I think the good news there is it does feel as though we're getting systems and technology in place that can allow us to work much more efficient here within the United States and globally. So maybe helping to offset some of that participation rate. But I found this chart to be kind of interesting dynamic within the employment picture. But looking more specifically at where are we in the stage, this is looking at the JOLTS job openings. And if you remember back 2-3 years ago, we had a situation where I think there were 2 job openings for every person looking for a job. There were job openings everywhere you could look, and markets were extremely tight. Wage growth was going through the roof because it was very difficult to keep or find that employee. That's coming back down into a more normalized range. I don't know if we head down to 4,000 or 6,000, but it's certainly on a trend that's getting back into a more historical range. So I think, that's a sign that labor markets are loosening up a little bit. Maybe neither here nor there, but I found this stat kind of interesting. In the last couple of days, we have seen the federal government, they were offered, many of you maybe seen the headlines, they were offered the ability to resign if they want from the federal government. And with that, they would get 8 months of pay between now and I think September. And the deadline is today. And it sounds like 60,000 federal workers decided to resign. So that might not be something where we see immediate impacts to the job data. But as they hit that workforce, you could see, particularly in the DC area, could see further slack within the labor market on things like that. Similarly, non-farm payrolls, it looks a lot like the previous chart, which is we are getting back down into a more normalized range. It doesn't look like a recessionary territory at this point, just kind of back into what we would have seen pre-COVID as a normal condition. So I don't think there's anything to be too alarmed about there. And then with regards to inflation of wages, so basically wage growth, that too seems like it's trending back down to at least back down to the trend line. I think we may even go beyond the trend line. But it looks like the idea of 6-7% wage growth seems to be pretty well behind us, and it's trending down, and likely, in my opinion, going to go south of 4% here in the coming months. So that should help to keep inflation a little bit in check. But I would say the employment picture looks pretty okay. Not spectacular, but pretty okay.